All right, on that note, we'll get started. So, like I said, welcome everyone to our latest webinar where we'll discuss an extremely exciting topic, RMD planning and IRMAA, with one of our senior wealth advisors here on the screen, Clark Schweitzer. Clark and I actually are both in our Wayne, Pennsylvania office. So again, thank you for joining us. We have a large number of clients tuning in today, which is fantastic. For that, we thank you. And certainly thank you for your time as well as for your trust in us. We pride ourselves in helping guide our clients through lifelong wealth and achieving that. And we don't take that responsibility lightly at all. And given the size of the audience today, I'm certainly happy that we're discussing a topic that seems to be top of mind for a lot of folks out there. So that's exciting. And for folks who are not clients of ours just yet, we certainly look forward to the opportunity to sit with you at some point to discuss this topic and others in the future. So a little logistic note before we get started here, and I want to quickly hand off the call to Clark. So we have about 45 minutes scheduled for the conversation today. We'll most likely spend about 30 to 35, and we'll have some questions and blocked off some time for questions at the end. If you do have any questions during this session, there's a button at the bottom of your Zoom screen, Q&A, with a little question mark sign in a box. Feel free to submit your questions via that tool. And like I said, we'll spend about 10-15 minutes at the end for any questions that we get. Clark has about 20 to 25 minutes of content that he'll walk through, and then at the end, we'll get to questions. This session is being recorded, so if you have to jump off early, no worries. You'll get an email shortly following the session with the recording of the content today. So with that, I'd like to introduce Clark. Clark is one of our certified financial planners and senior wealth advisor here at Diversified. He focuses on comprehensive financial planning and helping our clients achieve lifelong wealth, like I mentioned. He joined the firm back in 2021, bringing over a decade of experience in wealth management, including roles at one of our custodians, SEI, as well as a major brokerage firm. Clark takes a concierge approach with his clients, collaborating with industry professionals to deliver tailored financial solutions to his clients. A graduate of Temple University's Fox School of Business, Clark resides in Wayne, Pennsylvania, where we're located as well, with his wife and 2 children. So with that, Clark, I'm going to go off screen and hand it off to you.
Thank you very much, Steve, and good afternoon to everybody. Thank you very much for joining us here on this lovely spring-like day. So as Steve mentioned, I'm a senior wealth advisor here at Diversified, working with all of our clients in Wayne, as well as our clients in the Cape Cod, Massachusetts area and Boston area. So I get a little bit of luxury of working with some clients all over the East Coast here, basically all over the country. And this time of year is always exciting because, one, it's tax time, which I'm sure a lot of us love, but it really spurs a lot of good conversation with our clients, many of who are in that age range of retirement or soon to be retired. So, when we kind of plan these webinars out, it's always important to try to keep them timely, try to keep them, engaging for what you all want to hear, as well as what our clients are asking us. So, with tax time comes a lot of RMD questions, no surprises, things like that. So, when we had our last webinar on taxes, this kind of, dovetailed perfectly into really strategizing for the rest of the year. Obviously, the last 2 years of markets have been really rewarding and very fruitful, but, we're entering markets now where there's a little more uncertainty and a little more volatility that we've been seeing. So strategy and planning has become even more important than, in typical years when things are just going along very nicely. So, one thing I want to start out with is just introducing you all to some numbers that I thought were very fascinating, just with the demographics of our country and the baby boomer population, which I'm sure many of you on this call that I work with or work with advisors here at Diversified have been having the conversations about, is entering into that next phase of life, or if you're in that phase of life, trying to figure out the best way to optimize cash flow, reduce taxes, make sure you're putting yourselves in the best place year over year to, continue to live the lifestyle that you're living currently. So, with that, the baby boomer population is from the dates of birth 1946 year to 1964. So at this point, baby boomers turning 73, there's about 11,400 individuals turning 65 each day. As of 2025, there's 73 million individuals age 65 or older. So that makes up about 1/5 of the population of our country right now. So, as one could be sitting there thinking, wow, I fall into that category, it's important to realize that, this is a huge time for planning, for RMDs, for taxes, and really trying to get that cohesiveness together. So by the time 2030 comes around, every baby boomer will be 65 and older. So, just some statistics to kind of paint the picture of, where we are in the lifestyle right now. And, another quick in fact that I saw, which I thought was pretty astounding, was the average age of retirement today is 62. Go back to 1991, 30 plus years ago, the average age of retirement was 57. So I think we're all seeing a trend there that the age of retirement is getting shifted longer and longer. And that's important because as that has shifted, so has the needs for retirement, money lasting longer, individuals living longer. So, trying to account and adjust our lifestyles for, these more rapid changes that we tend to see is very important right now. And, having a plan together for when you get into retirement is very important. One being that our whole lives we're taught to save, put in your 401ks, spend less than you make, and then you hit this point in time where the income stops coming in. You're going to have to begin drawing from your portfolios, whether you want to or not. And there needs to be a strategy in place for helping reduce some of the pitfalls that we've seen come across for different situations. And the one thing to caveat before we kind of jump into some of this is everyone's situation is unique, right? We can give very general basis information here, but anything you have coming out of this webinar today, conversations or discussions from myself, the advisors you work with, or if you don't currently work with someone, you have questions, please reach out. Even for a quick consultation to kind of discuss where to start thinking, where to start planning. But everyone requires some unique advice in that stance. So with that, RMDs and IRMAA. So what we're going to be discussing today is how to manage RMDs. The old adage of you can just let it go and take RMDs when they come, that doesn't seem to always be the most effective anymore. With the changing code, whether it's the Secure Act 2.0, which changed how RMDs and inherited IRAs are handled, or different tax brackets adjust every single year, how that could impact you in the future when you do start taking RMDs. Let's be honest, whether you're 25 years old or 85 years old, no one likes to be surprised with a tax bill at the end of the year, especially in a year where you might not be making as much money as you used to. We want to avoid those surprises. So understanding what the IRMAA income-related monthly adjustment amount surcharges are and how to reduce those or avoid those in the future, and then planning ahead for retirement income. So we're going to go through some basic level stuff, but I'll try to drill down on areas that I have found with clients tend to raise more questions or can be a little bit more important because they can be a little complex. With the changes of the Secure Act that we've seen with retirement accounts, really basically completely overhauling in the last 5 years from right before the pandemic all the way through just last year, it's important to understand what you might be required to do, how you should handle your accounts, and if you are pre 73 or 75, what you should be considering today to put yourself in the best position kind of moving forward. So with that, what are RMDs? So RMDs are required minimum distributions, and these are associated with any of your qualified retirement accounts. Most of the time, it's all your pre-tax dollar accounts, your traditional IRAs, your traditional 401ks, inherited IRAs. It does involve Roth IRAs to an extent, or I'm sorry, Roth 401ks, kind of a separate situation. That is if you're still working, so I won't touch on that too much. So for all intents and purposes right now, all you kind of need to consider is really we're just talking pre-tax accounts and when those RMD ages occur. So, go back 10 years ago, the RMD age was 70 and a half. So you had all the way up to 70 and a half to kind of plan, and then you had to start withdrawing money from your IRAs. That amount is calculated on by the IRS. It's an expected life expectancy table that would then take a specific number, how long they project you to live, divided by that year-end balance for your IRA, and that would be that first year number. So what we've seen over these last few years is that number has shifted. So if you were born pre-1960, your RMD age now is 73. If you haven't started taking RMDs yet, it's 73. If you were born post-1960 or 1960 or after, your age is 75. There's no 74. It's just either 73 or age 75. So, it's important to kind of consider that, because a lot of times we'll have spouses who might be 2 or more years apart, and one will have to start taking them much earlier than another. So we can do different planning tactics to try to, figure out what might make most sense during those periods of time. How are the RMDs calculated? Again, it's off a life expectancy table. Usually that first year of RMDs is roughly about 3.7 to 3.8%. Many of you might have heard of the 4% rule, where, hey, if you can just take 4% of your account, it's kind of the gold number. You can withdraw that, every year, and you should never have to touch principal. So that's kind of been the rule of thumb. Obviously Social Security follows a lot of that. RMDs follow a lot of that. But as you get older, that number will get incrementally higher based on that longevity table. So, it's important that, one, we will most likely calculate that number for you every year, both either on your traditional IRAs, 401ks, or inherited IRAs, or, it's very easy to calculate yourself. There's tools out there to do it there. But within that first year, so let's just say you turn 73 this year. The year you turn 73 is the year you can take your first RMD, or the year you are required to take it. You can take it at any point during that year, or you can defer it and have to take it before April of the following year, April 1st of the following year that you turn 73. So basically when you are 74. However, if you defer it in that first year for whatever reason, you would then be required to take 2 that following year. So that conversation has come up a little bit on when's the best time to start taking my RMD. And, there's no silver bullet answer to it, because, it has to do with cash flow. It has to understand your situation, when you might need the money, if you even need the money. And, when we have a year where markets are straight up, you kind of hope, not knowing where the markets are going to go. We don't have the crystal ball, but not knowing where markets are going to go. The last 2 years, it would be better to necessarily take it at the end of the year, because you let that growth compound there. However, on a year where the market might be down, which we don't know, it could be more beneficial to try to take it in a more systematic approach, meaning either monthly distributions, quarterly distributions, or somewhere to that effect, that kind of evens out some of that volatility in the market. Every dollar that you take out of your IRA will be taxable as ordinary income. So, keep in mind that if you've never been taking money out and you've got a substantial IRA or RMD that first year, you're collecting social, you might have a pension, you've got to be prepared to have, maybe a substantial impact to your taxes, given that you might be taking a big RMD that year. So, the way we look at it is, one, through the planning tools that we use to kind of say, okay, where does all of your income come in from, and where do we fall within certain tax brackets? Tax brackets has been a big conversation here, as in 2025, we could see the Tax Cut and Jobs Act tax bracket situation sunset. That's kind of still up for debate. We aren't quite sure where that might go, but we have to plan for, if it does change, what does that impact look like, or if it doesn't change, how do we account for it in that measure? So, being able to have some flexibility with your RMD is very important. Real quick on the Roth side, there are no RMDs for your Roth IRA if owned by you. If you inherited a Roth IRA from a parent, or someone else, a non-spouse, there are certain 10-year rules that we have to follow if post 2020 or life expectancy pre 2020. So if you have a specific question on how to handle an inherited IRA or a Roth IRA, let us know. We can kind of figure that out with you. So, where does, outside RMDs, where does this very cool acronym IRMAA come into play? So IRMAA, as mentioned, is a income-related monthly adjustment amount, and it really applies to once you're on Medicare. So once you're on Medicare, you have to pay, certain costs for Medicare Part B potentially, and then Part D. Part B is basically your medical insurance at that point, and Part D is your drugs or your prescriptions. So, what they look at is a 2-year look back to your income, or said another way, if we're going to look at 2025, what you make AGI in 2025 will impact your IRMAA or any Medicare premium surcharges in 2027. So, the importance of this is that if you do bump up into the IRMAA tax brackets, it can increase that Medicare cost, which, could bump you up a few hundred to even a few $1,000s a year if not handled appropriately. Now, that could come from many different areas. It could come from, general income. Social Security does factor into IRMAA, but it is only that portion that is taxable. So you'll remember there's different Social Security taxabilities, up to 50% or up to 85% based on how much you are making in retirement. But, it is something that we plan for, and I plan for with my clients. And there's always things that come up, especially now with, different areas of really high yielding interest. Consider that as well. That's a kind of a surprise to people when they have, larger chunks of cash, and they might think, well, I get this in my pension or this in my Social Security. Don't forget about, some of that cash you might be holding, because that will add to your AGI there. So, if looking at 2025 income, thinking, okay, if I'm 63 this year, this is the year that it's going to potentially impact when I turn 65. If you're already Medicare age, you're going to be looking at, okay, how can I look at my IRMAA or my income this year, how it can impact IRMAA, how my RMDs in the future might, impact that as well, and what kind of strategies should I be considering in order to avoid kicking up into that IRMAA tax bracket. So what do those IRMAA tax brackets look like? Well, depending upon if you are filing jointly or you're single, those amounts are different. So, right, as 2025, the base premium you will pay is $185 per person. So if you're married, you're looking at $365, $70 in that range. So now times that by 12 months, and that's your IRMAA or your Medicare charge for the year. Once you go up above certain tax brackets, so I think these are the correct tax brackets here, as you can see, the 106 to 133. I believe that is filing separately or filing as a single. You're going to be looking at about a $74 IRMAA surcharge. Keep in mind, IRMAA-related surcharges are year to year. So it's not like once you go into it in year one, it's going to carry on forever. It's going to reset every single year based upon what that AGI or that MAGI, modified adjusted gross income, will be. Difference was between AGI and MAGI, you add back in certain items for modified adjusted gross income. You add back in some non-taxable interest. You add back in a couple other things. Ed, our accountant here, may have touched on that in our last webinar, but we can help. If you have a tax return that you can share with us, we can take a look at it with you and figure out, okay, where are we coming in at? Where can we potentially offset, maybe carry forward some losses if we have, some losses in the account this year. Qualified charitable distributions will be something I touch on next here. But, there are certain, tools we have in our toolbox to help avoid some of these IRMAA taxes, or even other just, increased taxes that you could come up against, down the road. So, in 2025, a couple could be looking at, if you make under $212,000 with AGI, you could be looking at about $440,000 of Medicare each year. You bump up above 212,000 to 266,000, you're going to be looking at about 6,200. So roughly, a little less than a $2,000 increase that the Social Security would come at you and say, hey, you'll receive a letter in the mail that says you have been, assessed the, IRMAA penalty here or surcharge. We're going to take that out of any future Social Security, however they might apply it. if you retire, let's say you're 65, you work, you retire, you're a high earner at that time, and now all of a sudden your earnings fall off. Okay, yeah, I was making 200, 300, 400,000 last year, but now that I'm Medicare age, I'm retired, I'm no longer making that. You do have the ability to file sort of like an appeal to the IRS or to the Social Security Administration there, basically saying, hey, this was a one-off situation. My income is projected to be lower moving forward. So you do have the ability to fight it if there is a good reason that your income was higher 2 years ago and it's not going to be higher moving forward here. So important things to kind of look out for as we assess 2024 tax returns and then kind of going into 2025 tax assessments, estimated tax payments, and things like that. So a big kind of buzzword that we hear a lot from clients are Roth conversions. And when do they make sense? Where do they make sense? Do they even make sense? And internally amongst us advisors here, we all have our differing opinions on when it would make sense, who it makes sense for, and the validity really of when to do it. And the one benefit of Roth, if anyone is not familiar, you get tax-free growth on that, as well as tax-free distributions in the future once you have money in your Roth. So the theory is, okay, if I'm not RMD age yet, I can start moving money, paying the taxes now, lowering what those RMDs could be in the future, and having some tax-free growth in the future. And that's the key big feature of doing those Roth conversions. One quick caveat: if you are RMD age and you think, well, I'd love to do a Roth conversion, maybe to offset some future RMDs, you can. You just have to satisfy that RMD first. So let's say your RMD on the year is $20,000, you're 75 years old, you're taking your RMDs, you would have to satisfy taking that $20,000 out, paying the tax, and then you could go back into your IRA and do an additional amount for a Roth conversion. But you have to take your RMD first. So Roth conversions, the real benefit with that too is time horizon, right? You want to give those accounts the ability to grow more. That's the whole benefit. Periods like we're seeing now, when the market runs up, you're not getting that Roth conversion opportunity necessarily, but you're getting money out of your IRA. It is advantageous in a year where the markets might be down or down for a short while to move money that is declined into your Roth IRA, pay the taxes, and then hopefully when the market does have a return or a bounce back, some of those depressed positions will recover quickly or give you that pop that you would otherwise not have in just a straight up year. So that's a good consideration for the Roth conversion. We have the ability to run different Roth conversion scenarios to show you whether I convert $20,000, $40,000, $100,000. There's no limit to what you can convert. It's just the ability to make sure you have cash to pay that Roth conversion. Because the last thing you want to do is do a Roth conversion, not have the cash to cover it, and then have to pull money from your IRA again to cover that tax. That is something that I personally would try to avoid. So qualified charitable distributions. So this is kind of what it sounds like. You're making a distribution from your IRA, usually your RMD, directly to a charity of your choice. It has to be a 501c3 charity. We make that check payable directly to that entity. And as of today, you can do up to $100,000 a year. You have to be 70 and a half in order to do those. So you can't do them at 65 or 68 or 69. You have to be 70 and a half. And we found that's a great way for some who have inherited IRAs, that they don't need the money to do some of that. That means that if you have a $20,000 RMD that year, it goes directly to that charity and you don't realize any of that taxable income. So you'll still get a 1099-R at the end of the year that shows, hey, you had a $20,000 distribution, but you get that receipt or you get that letter or invoice from the charity. You also file it on your taxes that you made a $20,000 qualified charitable distribution, and it doesn't show up on your taxes. It's not taxable income, and it will not impact your IRMAA. So it's a pretty cool way to be a little philanthropic, but also to help reduce your taxes in that effect as well. Tax bracket management, another good one that we kind of look at to show, when does it make sense to use taxable income tax-free or even tax deferred. Taxable income is just you have your brokerage account. You have a joint account with a spouse, you have an individual account. Tax deferred is those IRA accounts, those pre-tax accounts that you've put money into that have yet to pay taxes, but when you take money out, you then start paying those taxes. And then tax-free is the Roth. Once that money's in post-tax, it grows tax-free, which is fantastic. And then even tax-free distributions out of it. Another strategy, and again, anyone who's in that 62 plus range, these are all things you need to be thinking about, because you're probably thinking about the Social Security conversation. You're thinking about the Roth conversion conversation. You're out with friends to dinner. You're at the golf course. You're at the tennis racket club. You're wherever you might be. You're hearing probably conversations around what you should be thinking about, what you should be doing, and everyone has a good story on how they do it. But to really get your own plan in place, you can see here, it's not just a one size fits all. It's a very unique style approach and a very personal approach to each of our client situations. So, walking through our assessment of when you should consider taking Social Security, or maybe a spouse delays taking theirs and has another spouse turn theirs on so they can allow theirs to grow. These are very, they could seem like simple types of solutions, but the difference in one or two of these can really make a difference in what future taxes you might pay. Harvesting capital gains. Last 2 years straight of up markets was kind of tough to harvest any losses in an account. But so far this year, we've seen tech really suppressed in some of these bigger names that have had huge run-ups over the last 2 years. Now could be a time to potentially early in the year, March, April, May, harvest some of those losses, get back into the market after 30 days or avoiding the wash sale rule there so that the tax loss can be carried forward. And then hopefully maybe adding some of that back down the road as we get to year end to try to offset some gains you might have to take in certain features. So that'll help keep that taxable income below a certain amount so you're not hit with any unexpected IRMAA charges in the future. And then filing status. I know it's something that we probably, everyone here has been filing taxes for many years. And, most, if you're married, you've been filing jointly to get that, additional standard deduction. But there could be certain considerations around certain gifting, certain filing measures that might make sense to kind of consider there. So one other piece that I always like to mention to clients, if you're still working, if you're post 73, your RMD age, and you're still working, and you have a 401k, you are not required to take RMDs out of that 401k if you're still working. Now, if you're the business owner, different story. We can talk about that offline. But, one thing, and we do have some clients that are still working, they love their jobs, they like to stay busy. They do not have to take RMDs out of those 401ks if they're still working. So that's another caveat if that situation applies to you. So, a lot of different situations can unfold, and it's important to have these conversations to figure out what might make sense for you individually, you as a spouse, and then consider legacy, right? A lot of times the conversations we have about someone who's in their late 60s, early 70s, and they're doing Roth conversions, most of the time you might not need to touch that Roth money. That might be legacy money. It might be some money for a rainy day if there is some sort of assisted care down the road. But we have an order of operation if you have taxable money, which is just a brokerage account or a joint account, traditional IRA money, that pre-tax money that will require RMDs, and then Roth money. We look at it as kind of that holy trinity of flexibility in your future that you want to be able to maximize. Not everyone has that. So that's where if you just have that really large, old 401k or IRA, we need to be, very cognizant of how we handle that leading up to RMDs. And even once you do get into RMD age, there are strategies that we deploy to really help kind of combat, future taxes potentially. So, 72-year-old, $1 million in IRA and Social Security, maybe a pension, you're going to probably be in a pretty high tax bracket, come, working all those years. So discussing the Roth conversion and the QCB planning in your really, late 50s, early 60s, even all the way up through 70 is vital to make sure that there isn't something that comes out of the woodwork, or you don't get surprised with taxes, and really that your lifestyle doesn't need to change. Having the cash flow to, one, cover anything unexpected, but two, make sure you're not losing. We're all about keeping more of what you make. We all pay our share of taxes, and you want to make sure that you're not overpaying because of a mistake or oversight made 2 or 3 years ago, or 10 years ago, if it could have been avoided. So, all very powerful strategies to consider as we, kind of go through the whole planning process there. So, a couple of thoughts to kind of leave you with here. Start planning. If you haven't had these conversations yet, or if you have and you really haven't drilled down, run some different scenarios, talk about taking certain funds earlier than later. We don't know what the tax brackets might look like down the road. I think we're all aware of what our national deficit is, and that taxes are going to have to come from somewhere. So what change might that create down the road? We want to try to attack some of that now. Roth conversions and QCDs, manage that taxable income. When you pay tax, it's got to go somewhere. You can either choose to, have Uncle Sam get their cut, or if you want to try to be a little more strategic and give a little bit to charities or causes that you feel strongly about, we can always do a QCD to help offset that. Monitor the IRMAA brackets. We have a good way to track some of that spending and some of that taxes in the future. So those numbers, as everything kind of within the financial realm, it does inflate over time. So we want to make sure those numbers you're aware of those numbers as your income might change, drop, or go up, to make sure there's no surprises there. And then one thing I and everyone here at Diversified is very strongly about is having coordination with your CPA. Make sure your accountant, your financial advisor, even your state attorney or lawyer or other centers of influence are coordinated, because I think that just makes a stronger continuity there, and it kind of solidifies all of the planning work that everyone does. So, next steps: review your RMDs, have conversations with us. If you're Medicare age or going to be Medicare age, have the conversations with us. Chat through the Roth conversion discussion here to understand if Roth conversions make sense for you. If they don't make sense, we can help be a good judge of where that could come in at. But hopefully this was helpful. Hopefully this kind of gave you some thoughts to think about over these next couple of weeks here before tax season is over, or if you extend. A lot of good thoughts for conversation. Steve, one more personalized questions and
Yeah, absolutely. Thanks for that. I was politely reminded, I introduced myself in the beginning of the call. My name is Steve Wildman. I have the pleasure of working with all of our advisors across the East Coast, including Clark. So thank you for that, Clark. A lot of good info in there. We have a number of questions that came in, and we'll try to get to as many as possible the next few minutes here. But we actually received one prior to the call, and we'll kick it off with that. Question is, Clark, if I make a mistake and take out more IRA money than calculated for my RMD, can I carry over the excess amount to next year's calculation?
Great question. And unfortunately, no. So any amount you take out in that given year has to be realized that year and cannot be carried over. It would be nice if we could, but no. So to answer that question, no.
Got it. Thank you for that. So
one quick caveat to that.
Sure.
In a perfect world, if it's end of the year and markets have been down, it might help potentially lower a future RMD amount, because it's always based off the 12/31 prior year. But no, you can't carry over if you do take excess.
Okay. So actually the opposite side of that question is, what happens if I forget to take my RMD in any given year? Are there any penalties?
You call your financial advisor and you ask them why you forgot. That's the first step. Yeah, so there are penalties. So I think the latest was, if you forget to take an RMD, there's a 25% penalty on the excess amount, or the amount you didn't take. So if it's $20,000, you only took 10,000 would be hit with a 25% penalty. However, you are able, if you have a good reason, or if you reach out to the IRS or whoever and say, hey, I missed this, I'll make it up, they can reduce that penalty to 10%. It's still there, but 10% is better than 25%.
Understood. Understood. So sticking with the RMD theme, Clark, question came in around RMD withdrawals. And the question is, what are my options for reinvesting RMD withdrawals if I don't need the money coming out?
Sure. No, that's a great question. So you have a couple different options. One, if you're needing the RMDs to supplement your lifestyle and expenses, obviously, send it to your bank account, use it as needed, and live on it. But a lot of the times we do see clients who have sufficient incomes from pensions, Social Security, they might still be working. You can reinvest that. Once you take that money out, you can reinvest it into an individual account and keep it growing. It's a great way to, continue to build and compound on that wealth. A dollar that's lost to tax is obviously not compounded, but anytime you can put money back into the market there, it kind of continues to grow your wealth.
Great, thank you.
Or you can do a QCD and donate to charity.
There you go. All right, we have time for two more. So next question is related to income. It's a little different than the topic, but I think it's related. So the question is, starts off as, I see conflicting information on Social Security being reduced while you work. So the question is Social Security reduced while you work, part-time or full-time, and you're over 65 years old?
So yeah, so if you're still working and you're collecting Social Security and you're not full retirement age, your Social Security will be reduced by a factor. Don't quote me on the factors, I can get it, but it's usually $2, $1 for every $2 you earn, or $1 for every $3 you earn. But yes, the blanket answer is, if you're not full retirement age yet, you are collecting Social and still working, there will be some reduction. Now, that reduction is only up until you hit age full retirement, and then that would fall off. So you'd only have that penalty or reduction for that amount of time before full retirement age.
Right. So the 65 years old piece of that question isn't necessarily relevant if 65 is not your full retirement age.
Correct. Yeah. Nothing that comes to mind about 65 would reduce the Social outside of what I just said.
Right. And just a reminder, if you have questions or if you have additional questions after the session, or if we don't get to your question by the end of this session, feel free to reach out to your advisor here at Diversified, consult with a financial planner, and make sure that you get that answer, the question answered. So with that, last one, Clark, and then we'll let everyone get on with their day. Question is, I'm retiring in August at the age of 74. Do I have to take my full RMD on my IRA this year, or just a partial amount?
Good question. So you're 74 now. You're retiring this year?
Correct.
Retiring this year. So yes, you would have to take your full amount this year. However, you are eligible to, I believe, take it up to April of the following year. So it basically just starts like it would the first year. However, you can take it up to April following the year you retire or stop working.
Fantastic. All righty, we are at time here, folks. So thank you, Clark, first of all, for spreading your information and also answering the questions that came in. Folks, thank you for your time and attendance today. Like I mentioned, if you didn't have your question answered, or you have to have additional questions, feel free to reach out to your advisor here at Diversified. If you're not currently a client here at Diversified, we certainly look forward to the opportunity of speaking with you regarding any questions that you have, or any other topic, hopefully in the near future. So with that, I hope everyone has a happy and healthy rest of their week, and we'll see you all next time. Thank you.